Good afternoon, everyone. First of all, thanks to Chairman Sir and Regional Council members for giving me this opportunity. The topic given to me is audit and assurance in NBFCs, key audit checks or concerns in regard to IndAS accounting. So I think, whatever certain slides I prepared and previous speaker has covered it, so I will be just touching upon those slides and will be going forward. Okay. So first of all, the non-banking financial companies means a financial institution which is a company, or a non-banking institution which is a company and which has a principal business of lending, receiving or collecting money, or such other non-banking institutions or class of institutions that may be notified by central governments. For an NBFC to be registered, first after formation of a company, the NBFCs have to wait for a certificate of registration issued by RBI under Chapter 3B of the RBI's Act. And as of now, the net worth is 2 crores, and for the new NBFC formation, the net worth needs to be of 10 crores, and already existing NBFCs will have to take a net worth by 10 crores by 2027. So initially RBI started with NBFCs with 25 lakhs, then it went to 2 crores, now it's 10 crores. And like in 2021, the RBI did stop issuing the NBFC license for the regulatory purpose. But as of now, RBI have built up the supervisory department with, I think there were more than 200 to 300 people as SSM monitoring all the NBFCs. So yeah, to determine whether a company is an NBFC or not, if the financial assets are more than 50% of are deployed in 50% of the total assets are deployed in financial assets, and if the income is more than 50% of the gross income, then it's considered as an NBFC. I remember during the previous section, one of the person raising an issue whether a company incorporated normally, but due to whatever activities, the trading or manufacturing activities are stopped, and after that, in the intermediate period, the company is investing into financial assets, and more than 50% of the assets are employed in financial assets, and income is of interest income, whether it will be considered as an NBFC. If it's a temporary purpose, okay, you might take a view, okay, going forward there's a business plan. But I have seen many companies which started as a trading or manufacturing concern, but for whatever reason they stopped it, and being a private limited company, you cannot go for a liquidation so easily. So they deploy their assets, money into financial assets. To my view, those companies are covered under, are as a part of an NBFC, and since being getting deemed NBFC, not having a RBI registration certificate, it's a violation, which RBI sooner or later is going to look into those companies. So as an auditor, it's our utmost duty to look into those criteria where more than by 50% of the net worth is invested in financial assets, and my income is more of interest income. So this have been covered. NBFCs are at lowest level, base level, upper level, so I won't be going into that. Previous speaker has nicely covered it. So yeah, even like many of the corporates, they have number of NBFCs. They've got a different NBFCs for housing, for microfinance, for logistics. So when it comes to those corporate groups, all NBFCs put together, what is their asset under management, based on that the classification will be done. So it won't be on standalone in a group or having a same common promoters. So the NBFCs can be broadly classified into these categories: loan company, investment company, more than 50% asset have to be invested in financial assets, income have to be more than 50%. Asset finance companies, 60% of the funding has to be in physical assets supporting economic activity, and 60% of the income has to be from this financing assets. Infrastructure companies, 75% deployed for infrastructure loans, 50% income. CIC, core investment companies. I mean, usually this structure we see in big corporate houses where they got a 1 or 2 CICs holding shares of the other companies. So investment in shares and securities, 90% of that has to be invested in shares, and equity should constitute more than 60%. Factoring business, more than 50% of your income has to be from the factoring activities. So yeah, coming to now Audit and Companies Act, NBFCs having net worth above 250 crores are, below 250 crores are not covered under Ind AS. They can follow IGAAP, and based on IGAAP, they follow RBI prudential norms, IRAC norms. However, NBFCs having asset net worth about 250 crores have to compulsorily follow Ind AS. And the presentation of those presentation of the balance sheet has to be as per Division 3 of Schedule 3, whereas as per the companies not following Ind AS, the balance sheet presentation is as per Division 1, Schedule 3. In addition, NBFCs are required to disclose all the disclosure requirements as per RBI circular, issued from time to time. So now we'll be concentrating on the implementation of Ind AS in NBFCs. As far as once implementation of Ind AS comes into picture, I will go to have a board-approved policies that articulates and document business models, market conditions existing in significant sectors. Because when we're going to look forward, since as per IRAC norms, the asset classification or provisioning is based on individual accounts, but the account is standard, substandard. But once we come to a Ind AS mechanism, the provisioning in ECL 109 is based on a bucket, whether it's a microfinance, housing finance, real estate. So that it's not based on individual assets, but individual loans is based on a class of assets. So you got to have a market condition existing in significant sectors, because what are the market conditions? Those will be the basis for making your ECL model. Sound methods and underlying documentation is required for ECL computation. Justification for any change in ECL models to be documented and approved by the board. For each and every class of assets where we are going to make a ECL model or bucket, there has to be proper documentation, having data, having a past history. If I'm an NBFC having a past history and I got a related loan portfolios, then I have to look into those. What is the movement of accounts? What is the NPA percentage? And if I don't have those business models, then I might take data from CRISIL or those agencies which provide me the data which tells within first year so much chances of NPA, second year, third year, and during the lifetime of the assets. So compliance with rules and regulations and sound internal controls, and this is a management has to look into it, and even those charged with governments. That's the audit committee and board of directors. Because of lately, in the number of NBFCs where we are doing audit, the RBI is very particular whether the ECL models have been updated based on the economic scenario, current scenario, have been microeconomic factors have been considered, and whether those have been put to audit committee and board and properly documented, and as an auditor, what has been our role and how we have verified those. So a comparison between provision required under IRAC norms and impairment allowance under 109 should be disclosed to notes to accounts. This is a basic requirement. This IRAC norms provides a benchmarking to the board, RBI supervisors and other stakeholders. Because RBI norms are bare minimum. The objective of audit of financial statement is to enable auditor to express an opinion whether the financial statements of NBFCs are prepared in all material respect in accordance with identified financial reporting framework, including Companies Act, RBI regulations, and various circulars and notification issued by RBI on time-to-time basis. The auditor's report indicates the financial reporting framework has been used to prepare NBFCs. Now coming to the engagement, this is a broad methodologies I have covered, which no doubt as an auditor we are aware of it. While considering the appointment and the scope of audit, when we are going to do, we have to look into the model of business segments the NBFC is operating. Sufficient expertise in respect of financing experts, because as of now all the NBFCs, they are based on technology platform. They got a separate loan module, LMS module, separate module for KYC, and they are integrated with the core accounting software. So when planning an audit, we got to consider what are the softwares and IT technology being used and how they are communicating with the main accounting software. So this is a basic planning, assessment of risk and evaluation of internal controls, because depending on the business models NBFCs are following, they would be having a housing loan, they would be having a microfinance portfolio, consumer credit which is technically unsecured, personal loans, so shared fundings. So depending on the business models being followed by NBFCs, we got to do a risk assessment business activity wise. So based on that, we can plan our audit methodology and the sampling to be done. Conducting audit procedure compliance with regulatory, because there are different circulars and notification issued by RBI for disclosures, verifications and verifications under different categories. Whether it's a microfinance, there's a different there are different regulations. Consumer loans, there's a difference. Unsecured loans, and then analytical procedures to be performed and discussion on key issues. So this is the overall audit plan. I think I won't go into the details. Now, key audit checks, or as an auditors, which are the key audit areas that we need to cover? Balance with banks. Consider third-party confirmation and persuasive audit evidence, including balances with other NBFCs. Being the NBFCs, my main ingredient is money. Whether I take it as a deposit, whether it's the shareholders' funds, or whether it's the borrowing from banks. And where do I have a surplus money, I park it again in a bank. So we got to have a third-party confirmations from the banks or NBFCs. On sample, test check the bank reconciliation. See, I'll tell you about this bank reconciliation. In case of NBFCs, specifically NBFCs who are lending into business loans and housing loans, if you look at those bank reconciliations statements, we will have a loan sanctioned and appearing as a bank reco item for more than 3 months, 6 months, 8 months. Because usually what happens, when there's loans are disbursed by NBFCs or sanctioned by NBFCs, they hand over the check or they prepare a check and keep it there till the time all the formalities are not completed. In case of if it's a housing loan, till the time the loan gets sanctioned, based on the sanction, the registration is done. After you do a registration, the original documents have to be given to the NBFC, and then NBFC will disburse that money directly to the seller of the house property. But in intermediate, what happens, sanction is done within 15 days of the sanction. NBFC issues a check and they keep it in bank reco, shows the advance, interest starts, your installment starts. In case of a takeover of the loan, similar problems are there. Certain formalities are not completed, certain documents are not released from the erstwhile borrower, be it NBFC or banks. And in those cases, they show as an advance and show that as a bank reconciliation item. Based on that, the RBI has come out with a fair lending practice. Last year, 23 or 24, RBI came out with a circular on fair lending practice, wherein they have observed in NBFCs, specifically in NBFCs, where the loans are sanctioned and not disbursed for 3 months, 6 months, EMI starts, interest starts, so which have to be reversed and which cannot be remain as a part of a loan. So at least at year end, we'll have to see this bank reconciliation. There are no checks outstanding, or in case if they are outstanding, they have been cleared by, within a reasonable time in April. reconciling item impacting loan balances that and interest income. Review of reconciliation pertaining to escrow and control accounts. You know, NBFCs, I mean, typically big NBFCs, if you look into it, they've got an n number of accounts, and they've got all are IT based, software based. Certain accounts lies in core financial banking, certain lies in LMS, which has the control ledger of all the individual borrowers. So to save the account from getting NPAs, the entries are passed and parked in certain accounts. So those accounts needs to be verified as an auditor. In case of money market instruments, because generally in case of NBFCs, if there's a surplus funds, they are deployed in money market, and to meet their liquidity requirement also, they are parked in a money market operations. So reconciliation of physical inspection, confirmation with external custodians, establishment of ownership of instruments held in bearer forms or held by the NBFC, test for existence of sale or forward repurchase agreements, appropriation of valuation techniques that needs to be done, and test accrued income, amortization, gain, loss of the instrument, whether it has to be valued at amortized cost, whether is a fair valuation through profit and loss account or fair valuation through OCI. Other financial assets. Examine documents supporting the purchase, sale of such assets to determine whether all rights and obligations, warranties, options have been properly accounted for. This, warranties and options are all accounted for. This comes into NBFCs doing a leasing business. When you purchase an asset, whether warranties, options which are there in the assets are coming into my books, and then I'm again leasing it. So all those have been accounted for. Appropriateness of valuation techniques. Consider the nature and extent of any impairment review the management has carried out, whether the results are reflected in assets valuation. Because under India's, everything is based on fair valuation. It's a forward looking. So fair valuation has to be done. In case of depositors, since as discussed, like either we are deposit bearing NBFCs or non-deposit bearing NBFCs. But of lately, if you look at the mid layer, maximum of the NBFCs have come out with bonds, 8%, 9% bonds, which works as a tier 2 also for them, and which gives a much better, cheaper source of funding at 8 to 9%. Because generally, if you look at banks give a lending to NBFCs at 11 to 12%. So they got no other option other than to go for a bond borrowings, so which is 8 to 9%. Obtaining confirmation and performing analytical procedures whether deposit liabilities have been secured by, in case of the secured bonds, whether specific trust has been created and those assets have been secured under the trust. And in case of when they come out with the bonds, if you look into various bonds, they got various schemes: senior citizen scheme, monthly payout, quarterly payout, yearly payout, or lump sum payouts. And in those cases, we'll have to see that there is no default. The repayment of interest, in case it's a monthly interest, the monthly interest is repaid on due date to all the depositors. Otherwise, in case even if there's a delay for 1 day, you have to report in a CARO. There's a CARO, there's a clause of default. Deposit in transit. Deposit in transit between branches, NBFCs, or between subsidiaries, that needs to be verified. Reconciling items, examining individual item comprising balances that have not been cleared or with a reasonable time or still appearing. Capital and reserve. Banking RBI specifically pays very attention to what is a part of your net worth. That's the base, capital plus reserves. So capital and reserves has to be properly verified. Even a small change may affect a large effect on the NBFCs, because NBFCs who are on 10% capital adequacy for base layer of 15%, if they are just on 10 to 15% or their capital adequacy is based on that limits as per RBI, then any tinkering or any deviation might affect that going concern. Plus, we'll have to check and report on wide range of disclosures required under RBI. Now, what I'm going to do during this India's audit, I'm going to cover only two Indias, 115 and 109. I think to a certain extent, the 109 has been covered by our previous speaker. So 115 is revenue from contract with customers. As far as like if we look into our accounting aspect or IGAP, what happens during the NBFC's main income is interest income, processing charges, and other income. So under IGAP, as soon as I process a loan, I charge a processing income, which might be 1% or 2%. Under IGAP, I take the 2% as a processing income as my income during the year when I sanction a loan. But under 115, those income or processing charges what I have received won't be a part of our income, but it will be a part of the interest income which it's going to be considered a part of our interest income that will be distributed over the lifetime of the financial asset. So that is EIR, effective interest rate. Under 115, we'll have to use the effective interest rate method for all financial instruments measured at amortized cost. Discount estimate future cash assets through expected life of FA. Like EIR is calculated by considering any discount, premium on acquisition, commission, fees, costs, incrementally or directly attributable to specific lending arrangements. So when I do a lending, any costs I've incurred, even that will be attributable to over the period of time. Like most of the NBFCs, for small loans or microfinance loans, they appoint various agencies. So they pay them commission. So those commissions are not accounted as upfront expense. They will be appropriated over the useful life, over the financial loan tenure. If the financial assets becomes credit impaired, subsequent initial recognition interest income calculated net of provision. So in case if I book those income for processing income and those loans become impaired, whatever even the reversal I will have to do. Expense also what I've given as a commission to the agents, and if that loans become NPA, then whatever the expense I've deferred, even that has to be brought back to the P&L during that period. So if you look at basically revenue from contract for customer, it defines on the 5 parameters to be recognized based on 5-step models. Measurement based on considerations specified in the contracts. It will be governed by the terms of contracts. Exclude the amount collected on behalf of third parties. In case of there is any collection on behalf of third parties, that would never be part of my revenue from customer. High probability that a significant reversal of the revenue is not expected to occur. I should be like in case of a microfinance, if I pay a commission to a collecting agent, I should be aware of it that the chances of distributing this cost over a period of asset will be there. In case if I feel the chances of an account becoming NPAs are very high, it might be transferred to an expense account rather than amortizing over the period of the life of the asset. Loan processing fees, document fees, stamp fees, which are integral part of a financial asset, shall be recognized through EIR method over the terms of loan. For the agreement, foreclosure, transfer to assignment, the unamortized portion shall be recognized as an income. In case of I've sanctioned a loan where I've collected a processing fees, which I'm going to amortize over the loan of the asset. Going forward, that agreement loan is foreclosed or transferred from or assigned from NBFC to bank, then whatever income that has been amortized will be recognized as an income. Vice versa for the expense also. Dividend shall be recognized, is a standard policy. Dividend shall be recognized when right to establish. Net gain from financial instruments at FVTPL shall be recognized in profit and loss on trade debt basis. And in case of ARCs, asset reconstruction companies, they charge management fees and they take as an income. But when coming to the net worth calculation, any management fees outstanding for more than 180 days has to be reversed. NBFC following Indians are required to recognize impairment allowances. However, such NBFCs also need to maintain asset classification, compute provisioning as per RBI norms. A comparison between provision required in the IREC and India's 109 should be disclosed in NBFC. I think this was covered by the previous speaker also. to notes to financial account, which provides a benchmark to board, RBI, and other stakeholders. For the purpose of assessing the need to create an impairment reserve, auditors should understand the categorization of the financial instruments as standard assets, substandard, doubtful. SMA 0, 1, 2 has been discussed by previous auditor for IGAP. So already this was covered. I think that was a brief on a 115. I mean, do we have any questions for 115? Yeah. Sorry? No. I mean, when you file a computation based on this, certain FVTPL transactions, FVOCI is below the line. Certain FVTPL transactions have to be added less. No. Yeah, they're accepting. Yeah. Income recognition, they're accepting. And for 109, for the NBFCs, there's a separate provision for the, you have to work it out and you have to do the provisioning as per the income tax. So, income recognition, there's no issue. They've accepted. So coming to 109, financial instruments. So first of all, financial assets and liabilities are recognized when an entity becomes party to contractual obligations. Initially, it is recognized at fair value on a trade date, including transaction costs directly attributable. Whatever transaction costs are that becomes a part of a fair value, and it's initially recognized on that date. Then at the year end or at the reporting time, the FA can be classified into following three models, depending on the business model the entity NBFC is following. Whether it can be at amortized cost, fair value through profit and loss account, or fair value through OCI, depending what asset you are going to put in which category. Based on that, you'll have to do the valuation on reporting date, whether it's in case it's a listed NBFCs quarterly or half yearly or yearly. And business model assessment is at portfolio level. Like in case of IGAP, we do it at account level. Here it's at a portfolio level. A reclassification measurement applied. In case there is any change in classification or the terms of contracts, then under 109, the reclassification is done from the prospective date and does not consider the previous history of it. So impairment reserve, what was discussed previously by the speaker, this is a base requirement as per IRAC norms. And under 109, under ECL model, what I do, I compare. In case my ECL provisioning is less than the IRAC norm, impairment reserve needs to be created, and that cannot be withdrawn without the permission of RBI. So yeah. When it comes to 109, where we under IGAP, we have got a standard, substandard. Here we have got stage 1, stage 2, stage 3. Stage 1 technically covers the asset where it's a SMA 0 to 30 days. Once it goes beyond 30 days, the asset, financial asset moves to a stage 2 and it remains there from 30 to 90 days. And once it becomes an NPA, it moves to stage 3. So financial assets, on the date of transaction, it's recorded at fair value, including all directly attributable costs and subsequent measurement happens through FVTPL, FVCTOI, or options are available for certain. Generally, all equity instruments are through fair value through profit and loss account. However, in certain cases, the option of routing to OCI is also available in case of equity instruments. That basically pertains to either my subsidiary companies or my associate companies, where I may not go through fair value or through profit and loss account. Amortized cost generally happens when a security or financial asset I am having investment like debentures or government bonds, and which I am going to hold till the end of maturity. Then I go for amortized cost. Or otherwise, long-term instruments are there. Then I go to OCI. So once if I routing to FVTPL or OCI, FVT OCI, then the impairment doesn't come into picture. All the assets which are not fair valued, then I have to do an impairment testing. So basically under Ind AS, each and every asset or line item under balance sheet needs to be evaluated. Either it's to fair value or amortization has to take place. So now coming to the ECL model, I mean this was discussed, PD into LGD into EAD. So these are the risk parameters based on which my ECL model needs to be developed, and ECL model will be developed based on class of assets. Microfinance, because microfinance the probability will be high. Consumer loan the probability will be high. Housing finance the probability of defaults are low. SME the probability is different. So probability of default or likelihood that a borrower will default, loss that a lender is expected to incur if a borrower defaults, the forecast exposure at each point in time. See, I'll tell you, in case of NBFC starting a new business portfolio, they expect during the initial year or based on our data, the expected probability of default will be 5% of the given loan portfolio. So based on that, they make a ECL model for a 1 year, and after 1 year or 6 months, they come to know the market which they are catering into it, or the area or geography where they are catering into. The default rate is more than 5%, 10%, 15% or 20%, whatever. The estimates are changed. Then the ECL model and probability of default needs to be changed, and the ECL model needs to be updated based on the experience. So what is probability of default? PD is measured of the likelihood that a borrower will default on the financial obligation. Can be estimated using a range of quantitative and qualitative information, including historical data, credit loss, borrowers-wise specific information, and macroeconomic, depending on the areas and geography where you are operating. PD is often expressed as a percentage that can be estimated for individual financial asset or a portfolio or a class of asset that will have a loss. So a particular asset can have a loss up to 10%, 20%. Like in case of a microfinance, if you look into the ECL model of the microfinance, usually like if it's up to stage 1, okay, normal provisioning. But once it moves to stage 2, they provide for 60. And once it moves to stage 3, it's 100% provisioning. Or many of the NBFCs in case of microfinance, after 90 days, they got a business ECL model of providing 100%. So LGD, loss given default, it represents a portion of the outstanding loan balance that a financial institution expects to lose in the event of default. It's calculated by subtracting the expected recovery. Like in case of a housing loan portfolio, the ECL model in case of a LGD will be very minuscule, because I know when I'm giving a housing loan, it's most of the 90%, 80%, 70% will be covered by the security what I've got. So the LGD rate in this case in housing loan will be very low. In case of a business MSME loan, depending on the collateral or working capital for the debtors and inventory, it might be a different LGD. So depending on each and every business portfolio, the LGD will differ. The factors influencing calculation include collateral, regulatory requirement, environment requirement, and economic requirement. Accurate LGD estimation is important for financial institution to account for credit risk and make appropriate provisioning for ECL. In fact, like as an auditor, I mean, this is one of the gray areas, and where RBI SSM do come and sit with auditors, asking each and every detailed questions about the ECL models, prepared by, see, technically the ECL model have to be prepared by the management, approved by the audit committee and the board, and all the documentation that is required for the preparation of the audit ECL model needs to be placed before the audit committee. So technically the audit committee is supposed to look thoroughly into it. In case if the audit committee is not that, it's a board. But as an auditor from RBI, now of lately almost all the RBIs in mid and upper layers are covered by RBI on yearly basis. So RBI SSM, they come and sit with the auditors. They ask each and every micro questions on the business or models of ECLs, whether you have verified, what are your documentations, what documentations you have done, why these factors they have considered. So as an auditor, this is one of the, because see 109 defines my balance sheet, profit and loss. So as an auditor, this is the only gray area where I have to devote maximum time. And see, in case of banks where we do audit, we look into a individual loan account, we can verify loan account, movement, value of security. But NBFCs, they've got a total class of loans where it's not possible for as an auditor to verify each and every single loan. So they look into this ECL model, and we have to be very careful in this ECL model whether all the components, default ratios, exposures have been considered into that ECL model. Past data of the NBFCs, we can look into it. Or there are agencies like CRISIL, they have their ECL model. So what is their benchmarking, whether for particular class of asset, in first year there's a 5%, going forward there's a 30%, the recovery rates recovery chances are very minimum. So based on that, the ECL model is done. And as an auditor, it's our duty to look into this ECL model, document it, have a thorough discussion. So this is a movement under ECL. Stage 1 is performing. When it's up to 0 to 30, it comes under stage 1, wherein probability, loss given default and exposure is considered as expected for next 12 months. But when it comes to stage 2, that's underperforming. From 30 to 90 days, it remains here. And in this case, the lifetime expected credit loss is considered. In case the loan has become a stage SMA 1, then what is the exposure, and till the lifetime of the loan, what is expected of the credit loss, that needs to be factored in. And in case of a stage C, that's a non-performing. Beyond 90 days, all the financial assets will fall under a stage 3, and that's a non-performing. And in this case also, we'll have to look into the lifetime expected credit loss, which might vary from stage 2 to stage 3. So I mean, like previous speaker said, whether once the account is NPA under 90 days and it comes to 89 days, under ECL model, can I shift it to stage 2? Because under IRAC norms, the DPD has to be 0, all overdues has to be clear, then only it can remain standard, otherwise it will remain under substandard or D1. But under ECL model, can I shift it from stage 3 to stage 2? I mean, it's up to the management, up to your ECL policy, up to your board. So, and for this, I mean, we'll have to look into this thing when account is moved from stage 3 to stage 2. I mean, what's the frequency, the number of accounts moving from 3 to 2, 2 to 3, 3 to 2. So in case there's a vast variation between 2, 3, 3, 2, then as an auditor, it's my duty. I have to look into that ECL model and question the management. Why? I mean, for 89 days, they're shifting here. After a 15 days or next installment falls due, the account becomes NPA. Again, it services one installments. 60 days are outstanding. Again, it comes to stage 2, 3, 2, 3. Then as an auditor, I have to be very careful on this. And under stage 3, in case there's no security, straightway it's better to write off rather than carrying it under financial asset. If the in case there is a significant deterioration of the asset quality when the asset was initially recognized, then which can be based on financial difficulty or breach of contract. Financial difficulty, then you will have to do a assessment under quantitative and qualitative, whether it will go to stage 2 or stage 3, and provisioning factor will have to consider. If significant increase in credit risk is established, asset can be classified in stage 2 or stage 3 depending on the life cycle. So stage 1, what do you mean by stage 1? Under stage 1, 12 months ECL reflects the cash shortfall over the life of the loan arising from a default. So when the new loan or new financial assets which is SMA 0 or which lies in 0 to 30 days, under that, I mean, we take a probability how much for next 12 months only that can be a default probability. We don't consider lifetime asset till a lifetime, which in case of a housing loan which is for 15 years, 20 years, then under stage 1, I'm going to consider only for 12 months, in spite of the fact that the housing loan is for next 15 years. Because I said stage 1 SMA 0 account, so I'm going to consider the chances of default for next 12 months only. And once it moves to a stage 2, then naturally it's a 15 years loan, then I'll consider based on all full 15 years, how much is going to be a default liability, and the provisioning based on that will increase. So lifetime ECLs are total expected cash shortfall after security, if you've got anything, arising from all possible defaults events for the life of the loan. Asset migrates to this bucket if the credit risk has increased significantly from initial recognition. So there are various reasons for staging for risk assessment. Change in external environment, market conditions, adverse change in business or economic scenario, internal watch list, changes in internal price indication, change in credit rating downgrade, change in value of collateral or repayment behavior, change in external credit rating. So all these things have to be factored into your ECL model. So when particular factors or economic scenario will change, and what will be my ECL provisioning. In case of NBFCs who are operating into different geographies, geography like south, north, east, then economic scenarios are different. Then ECL model have to factor into all those. Like in case of a gold loan like ECL model is different because as such NBFCs give 60 or 70% of the gold value. So based on that, the ECL model is different. For microfinance, the ECL model is different. Now coming to, I mean, that was from 109. Any questions on 109? Now coming to fraud, I think as an auditor we are aware, in case of NBFCs or banks, one of the main areas is of fraud because that's they deal with money, they deal with disbursement, they deal with lending. So there are chances of fraud and diversion of funds. So I mean in regard to this, as an auditor, it's my responsibility. I look into SA 240, auditors responsibility relating to frauds in audit of financial statements. And there are various circulars issued by RBI in regards to classification and the reporting of frauds. Under RBI definition, fraud, a deliberate act of omission or commission by any person carried out in course of banking transaction or in books of accounts maintained manually or under computer system in bank, resulting into a wrongful gain to any person for temporary period or otherwise with or without any monetary loss to the bank. So in case even if there is no monetary loss to the bank or NBFCs, the account the transaction can be taken as a fraud by the RBI. RBI has issued a circular requiring all NBFCs to report the occurrence of any fraud committed by the borrower or by the employees. See, and as per RBI, The reporting of fraud involves three stages: one above 1 lakh and above, from the borrowers, and above 1 crores. In case of fraud up to 1 crore, as an NBFC, you are supposed to report to the regional office of RBI to DNBS, that's the Department of Non-Banking Supervision. In case of fraud above 1 crore, the management has to report that fraud details to regional office and central office. Central office that is in Mumbai, DNBS department. So these are various reporting formats needs to be given to RBI. FRM1, reported on actual or suspected fraud within 3 weeks within the date of detection. FRM2, quarterly reports on outstanding fraud within 15 days from the end of the quarter. FRM3, quarterly progress report on frauds above 1 lakh and above. This is a progress report for fraud 1 lakh and above within 15 days from end of each quarter. And these are the reporting requirements which NBFCs have to follow. And as far as this are concerned, as an auditor, what is my role? As an auditor, when I give, we give one audit report we give, and one is a audit report addressed to Board of Directors, which I'm going to cover in subsequent slides, where the RBI requires me to give a detailed disclosure on whether all the regulations and the filings have been done by the bank or not, NBFCs or not. If not, then I have to give that exception report to the RBI also. So as a part of our auditors, it becomes my responsibility to look into this. Like kinds of fraud, there's a fake KYC document, stolen checks, loan sanctioned without appropriate documents and sufficient securities, forged documents, or evergreening of borrower accounts. Now coming to the reporting requirement as an auditor. So first of all, under 143 of the Companies Act, I as an auditor have to give a report, and then RBI through section 45 MA of RBI Act have laid down powers and duties of an auditor. Under 45 MA 1, auditor to inquire if NBFC has submitted to RBI all the requisite information. That means all the previous filings what NBFCs are supposed to do, and statements of particular regarding deposits accepted by it, exceptions, and aggregate of such. This is a reporting under 45 1A where there are 42 points questions which I have to give, whether it's a deposit taking, deposits are there. 45 MA2 where auditors report or intend to report to RBI under section 45. The matters should be included in this report under 143.3. And 45 MA empowers RBI to issue directions to NBFCs and auditors for carrying out certain procedures or disclosures in regard to balance sheet, profit and loss account. In fact, 45 MAA, which was amended by Finance Act 2019, RBI have taken a power where they can issue instructions to auditors to look into specific areas or report under specific regulations and report to RBI. And in case as an auditor, if we fail to do it, RBI has got power to debar us for 3 years from doing the audit of any of the NBFCs or RBI regulated entities. So 45 MA gives power, and 45 MAA RBI has taken power where they can debar auditors. So these are the matters like a separate report where we have to submit to the Board of Directors, and Board of Directors in turn submit to the RBI. And in case if there is a deviation in this report, there is an exception reporting which as an auditor we are supposed to directly report. So some of the other matters to be reported to non-deposit taking NBFCs is whether company is entitled to hold certificate of registration. We have to give the number of the registration number also and date of registration. Whether Board of Directors have passed a resolution for non-acceptance of any public deposit. These are the basic requirements we have to verify, and every year we have to give them. Whether the company has accepted any public deposit during the year. Being a non-deposit NBFC, have they accepted because I mean under 143 as a normal auditor it's not covered. So as an special report, I have to submit this report. NBFC is meeting required net owned fund requirements. Whether company has complied with prudential norms on income recognition, accounting standards, asset classification, and in case of Ind AS 109. And in case of deposit taking NBFCs, whether public deposits are within the prescribed limits, deposits accepted without minimum investment grade trading, any restriction, default in interest payments, capital adequacy, and NBS has been furnished on quarterly basis. So I mean there are some 15 to 20 points which needs to be covered and reported. And in case if there is any violation, as an auditor you will be issuing a exception report directly to the RBI. In fact, like as in Form A we have to submit during the course of appointment. We have to give to a Form A. That Form A goes to the RBI non-banking department, which we have to file. So all these are requirements, and of lately RBI has been coming quite heavily on the auditors for mid-layer NBFCs, where there are bit of non-compliance also by the auditors. So exception reporting is only on instances of non-compliance. Only non-compliance out of those previous, out of this, in case there are any non-compliance, 1 or 2 or 3 points, then exception reporting has to be only for those 3 points. Then based on XBRL, returns have to be filed, which specifies 42 questions. Then auditors be aware of RBI direction. As in case the NBFCs are listed, then we have to take care of the LODR also. And for the previous report certification, which we give it to Board of Directors for this one, there's a report, guidance note on report or certification for special purpose issued by ICI. We have to consider that. In fact, even when you do give a report, exception report to the RBI, based on a guidance note issued by ICI, needs to be considered. So, one of the areas which, when NBFCs, when you look, in case you are doing an audit for NBFC of mid-layer or upper layer, the loans sanctioned by the NBFCs to the borrower, and in borrower in turn, who is the ultimate beneficiary, needs to be looked into it. And ultimate beneficiary clause is required under companies as an auditor also, and as an RBI, they are going much more into details for the ultimate beneficiaries when large amount of loans are disbursed. So ultimate beneficiary should be, because there are two ways. I take a loan and invest in another company. So taking a loan, or from whom I have taken a borrowing, who is the ultimate beneficiary, when I invest either as under equity or under loan mechanism or funding, who is the ultimate beneficiary. So ultimate beneficiary needs to be looked into, whether for borrowing or whether for lending. Now these are a few CARO points. I think, do I need to cover the CARO points from the NBFC point of view? Because there are under clause 3, under clause C 7A, I mean you are supposed to require report under 45 IA. I mean there's a principle 50% of the business activities are carried, or 60% or 70%. So these are the few clauses which are required under CARO. Whether the company has conducted any non-banking activity without a valid certificate from Reserve Bank of India as per RBI Act. This is one of the points where you might have to report, where continuously a company is carrying on a financing activity, more than 50% of the assets are deployed in financial assets and the income is more than 50%. So that call will have to be taken. If the company has carried on activity of non-banking or housing finance activity, and I applied for registration or not applied for registration, that needs to be mentioned. In case of a CIC, there's a one CARO point, but needs to be covered. Which I mean, as a CIC, you're supposed to have a more than 90% investment in, supposed to have more than 90% of assets deployed in investments, and 60% have to be in equity shares. That needs to be looked into. If that is not being followed, then under CARO, I have to give a observation. Now, these are the list of irregularities observed by Reserve Bank of India during their inspection. As an auditor's, net owned fund below minimum required level. In case the net owned fund goes below the minimum required level, as an auditor, I am supposed to report in the board of directors report, and I am supposed to report it to the RBI also, where many of the auditors have failed to do that. So net owned fund has gone below minimum level, and now as an auditor I have failed to report to the RBI. Item not to be included in free reserve has been considered. So in case of a share, in case any shares are to be redeemed in future at the share premium, and which has not been considered for the, which needs to be excluded from the net worth, has not been considered. Company has not obtained registration certificate from RBI, failure to comply with prudential norms in case of NBFCs or non-deposit taking companies or prudential norms or directions. This is for IGAP. Non-reporting of downgrading of credit rating of deposits taking NBFC. In case of NBFCs taking a deposits, then to go to a public, there has to be a credit rating agencies, certain gate, below certain gate, you cannot go to go and borrow. In case there is a downgradation by the credit rating agencies, so as an auditor, I am supposed to report that, and I cannot, NBFC cannot go for a borrowing. Failure to report to the conditions addressed in CIC or any directions given by RBI on time to time basis to any particular NBFCs. If they have not followed, then as an auditor, I am supposed to issue an exception report directly to the RBI. Bill discounted by NBFC arising on the sale of commercial vehicles, and I mean these are the observations issued by RBI. Investment by NBFC, any company entity by way of shares or debentures. Unsecured loan, intercorporate deposits within intercompany, all types of to subsidiaries. This is a risk weightage, capital adequacy, which is 10%, 15%, I think, which was covered by the previous auditor. So what is tier 1? Total capital fund is tier 1 plus tier 2. Tier 1 includes equity, net owned funds, and free reserves. Tier 2 is subordinate debts, bonds are considered part of a tier 2 revaluation reserve if has been created for immovable asset, that is considered certain weightage. 50% weightage is given for tier 2. Hybrid into by subordinate general provisions. Perpetual debt instruments are part of tier 2. CCPs, if they are going to be fully convertible into equity shares in future, will be a part of tier 1, excluding revaluation reserves. And risk weightage, I mean for each and every class of asset, the RBI has come out with a detailed circular. Like unsecured loan, the risk weightage is 100. Gold loan, the risk weightage is lesser. You got a cash and bank balance, the risk weightage is 0. In case of investments in government securities, the risk weight is 0. So based on that, the risk weightage needs to be arrived at and certified. Now there are separate guidelines issued by RBI for digital lending, which needs to be followed. RBI on time to time basis have come out with a fair practice code. So loan application they're processing, interest rate has to be mentioned. Previously, interest rate was not mentioned by NBFCs. the due date of installments was not mentioned, interest due dates were not mentioned in the loan application. So all these were openly left by NBFCs since they were not regulated or they were not so much looked after by the RBI. But of lately now they come out with a fair practice code where the due date of installments of interest and principal has to be specified, whether it's a 15th, otherwise it was like monthly. So monthly could be first of month and could be 31st also or 30th also. So now last year they came out with fair lending. In 23 they come out with this fair lending circular, dates have to be mentioned. And in case of when your loan disbursal or your sanction here, clearly the charges have to be mentioned. Otherwise NBFCs like banks, when we look into a proposal, they give a detail into sanction letter, but NBFCs were never giving into it. Whether there will be prepayment charges, prepayment penalty, foreclosure penalties, those were never a part of a NBFC sanctions. But under fair practice code, they have brought it. In fact, under fair practice code, like what we discussed, in case of a checks issued but not disbursed, that is covered under fair practice, and the interest, if you have charged anything, has to be reversed. So I think that's from my side. Anything more? Or any questions? Yeah, earlier option can go for it. Earlier adoption, there's no issue. No? In fact, like any accounting standards, even being issued by institute, earlier adoption is always welcome. Sorry? So, yeah. As an auditor, before accepting a audit assignment or taking up an NBFC assignment, I mean, as an auditor, my main role is they are focused into what areas, what line of business activities, and their IT platform. Because, see, as of today, when NBFCs are growing, all NBFCs, mid-level NBFCs, they come out, they have got a strong LMS network that gets integrated with my financial accounting. They got a separate for KYC, separate software for different. So as an auditor, my main lookout has to be what sort of technology they are using and what sort of business models they are into. Whether microfinance, then you got to have that detailed knowledge about microfinance. Consumer, housing. So these are two critical areas. As an auditor, it's my responsibility, and I deploy and plan my audit procedures and sampling based on those technologies. In fact, like nowadays when we are going to do NBFC audit, as an auditor, I got to have a good person with IT background who can do the general testing. And whether all controls are in place, because based on that, my ICFR report is based.
Hello.
Sir, on the slide of frauds, there was a point on evergreening of borrower accounts. So how, as an auditor, can we independently check those frauds? Because those will be, definitely layered transactions. Independently, how can we check?
So, yeah. First of all, like ultimate beneficiary. I mean, their ultimate beneficiary, even there's a routing to ultimate beneficiary. You remember last year, 2 years back, RBI coming out with a circular for ARCs. NBFCs cannot invest more than 20% in ARC. So what was happening prior to 2 years back, 23 में वो circular आया था ARC का, कि in case your NBFCs come out with a ARC, they transfer that loan to ARC, they are 100% shareholder, they come out of year and the account becomes nil. And so RBI came out with a circular in 2023, wherein in case the NBFCs are holding more than 40 or 50% in NBFCs and there is a lending, the full provisioning has to be done. Now they come down, the NBFCs can invest up to 20% into ARC. So evergreening, I mean, it has to be like big ticket accounts. You have to look into it. Finally, who is the ultimate beneficiary? I mean, in case of NBFCs, if you look into, I mean, this evergreening generally happens for NBFCs in case of a builder loans, real estate constructions, where the ticket size is really huge. So ultimately, it's as an auditor, it becomes really different. In fact, when we do a bank audit, there also the window dressing needs to be looked into. So, but NBFC generally in evergreening has been happening in case of real estate loans. Otherwise, it's a small loan. But when in case of real estate, I mean, they are lending to the two joint ventures of the same builder. One account becoming on the verge of becoming NPA. This joint venture, because builders, as such, builders come out with a joint venture for each and every project. So what they do, I have lended to a joint venture. When that account is on the verge of becoming NPA, builder comes with a B joint venture, I lend it, then money goes to that and it comes here. I mean, that has been happening. Thank you.